A number of trading platforms now exist in Europe that allow retail flow to be matched automatically against trading firms that specialize in retail business, typically high-frequency trading firms. Prior to MiFID, there were no choice. Retail orders were traded on exchanges' central order books and therefore interacted with multiple trading interests anonymously. With this choice also comes an obligation, that of best execution, the burden of which is borne by the intermediaries who owe their client the best price. With this choice comes an opportunity for HFT firms to offer a best execution service in the form of order flow privatizations. Brokers choosing this solution no longer need to connect to all the different liquid trading venues, providing access to those instruments. The primary reason for the emergence and rapid development of this practice is that it provides the HFT firms acting as market makers on retail flow platforms with a significant and almost risk-free source of revenue. The landscape has become complex for retail, and it is the broker's responsibility to make choices, always keeping their clients' best interests in mind rather than their own.
The retail flow trading platforms argue that they are actually offering a best execution service to their clients. And that's a very tempting proposition for a retail broker who has the choice of many different trading platforms and who has to face the cost of potentially having to connect to each one of those platforms. We see that there's a lot of risk associated to that. On the one hand, investor protection is at risk because these brokers are incentivized to choose one platform over another, and at the same time there is a potential impact on the market as a whole, because as these flows are basically being removed from the central order books of truly transparent multilateral platforms, what you can see in the market, the buying and selling interests that are published and disclosed to the market, are no longer truly representative of the interests in that market.
We make 4 key proposals for MiFID II that we believe will improve retail investor protection and protect the price formation process across financial markets. The first one, more transparency over routing policies. In order to help investors monitor the quality of execution provided by their brokers and to reduce the motivation for brokers to prefer their own interest over those of their clients, we believe it's necessary to place strict disclosure requirements on brokers regarding their execution and routing policies. We recommend that brokers are required to publish monthly reports on their execution policy, detailing all the venues to which they route client orders and the nature of the relationship they have with these venues. For instance, routing arrangements, maker rebates, shareholding, etc. These reports should also include information and data on the quality of execution and any potential price improvement received on these venues.
Our second proposal is that we need clearer definitions as to the characteristics and requirements of trading venues under MiFID. These retail platforms have developed as a result of the wide scope for interpretation left under MiFID as to the requirements and obligations of these trading platforms. In order to remove the ambiguity and to ensure that all trading platforms abide by the spirit of MiFID, we highly recommend that a definition be drafted in order to describe very precisely the characteristics and requirements per trading venue type under the new revised version of the directive. The third proposal is that we need a clearer definition of pre-trade transparency. Pre-trade transparency is important to private investors, any investor, and to the market as a whole. The definition of pre-trade transparency is basically the disclosure to the public of the bid and offer prices and the depth of trading interests present at those prices. This would avoid trading platforms from displaying order books that are misleading and that do not truly represent the interest present on that platform. This would allow us to draw a clear line between truly pre-trade transparent platforms which aim to contribute to price formation and dark platforms which are not price forming.
And finally, our fourth proposal, prohibition of payment for order flow. Payment for order flow can take diverse forms, direct payment, rebates on other services, etc. But in all cases, it increases the conflict of interest that brokers face regarding the execution of client orders. These incentives encourage brokers to focus on the payment they can receive in exchange for the routing of client orders rather than on the quality of execution offered by trading venues. We recommend that all forms of payment for order flow should be prohibited in respect to the routing of client orders.